Imagine opening your trading app late at night and realizing that owning a piece of an American company does not require thousands of dollars anymore. Right now, in the US stock market, there are companies whose shares trade around just $10, an amount most people spend without thinking twice. Many investors scroll past these stocks because they believe a low price automatically means low quality or high danger. But history shows that some well-known companies have traded at these levels before making powerful comebacks. Tonight, we are diving into why these $10 US stocks exist and why they quietly attract the attention of serious investors. Now, let me welcome you properly and explain what this video is really about before we go any further. A stock's price alone does not tell you how big or valuable a company actually is, and this is where most beginners get confused. A $10 stock can represent $1 billion company facing temporary pressure, market fear, or industry slowdown. At the same time, expensive-looking stocks can still be risky if the business behind them is weak. In this video, you will learn how to think beyond price, understand why some US companies trade near $10, and approach these opportunities with a calm and informed mindset. When investors talk about low-priced US stocks, especially those trading around $10 or below, most people assume these companies must be weak, failing, or close to bankruptcy. That assumption is one of the biggest misunderstandings in the stock market. A stock price does not represent how big a company is, how many assets it owns, or how important it is in its industry. Stock price is simply the cost of one share, and that price moves based on expectations, fear, growth outlook, and overall market sentiment. This is why the US market often pushes strong or well-known companies into the under $10 range during uncertain times. One of the clearest examples of this misunderstanding is Nokia, a name almost everyone recognizes. Many people still associate Nokia only with old mobile phones, but today the company operates mainly in telecom infrastructure, networking equipment, and 5G technology. Nokia supplies hardware and software to telecom operators around the world, including work on next-generation networks. The stock has traded under $10, not because the company disappeared, but because revenue growth has been slow and competition from other global players has been intense. Investors constantly debate whether Nokia can regain strong profitability, which keeps the stock price suppressed despite its global presence and long operating history. Another company that tells a similar transformation story is BlackBerry. Once a smartphone giant, BlackBerry failed to compete with Apple and Android and lost its consumer market dominance. Instead of shutting down, the company pivoted towards cybersecurity, enterprise software, and secure communication systems. Today, BlackBerry focuses on software used in vehicles, governments, and businesses that require high security. The stock often trades under $10 because investors remain cautious about whether this transformation will fully succeed. However, the company still generates revenue and owns valuable intellectual property, which is why it remains on the radar of long-term investors. Moving from legacy technology to modern consumer platforms, Snap Inc., the parent company of Snapchat, is another example of a recognizable US company trading under $10 at times. Snap operates one of the most popular social media platforms among younger users, with millions of daily active users worldwide. The challenge for Snap has not been popularity, but monetization and competition. Advertising revenue fluctuates heavily based on economic conditions, and competitors like Meta and TikTok fight aggressively for ad dollars. Because growth slowed and profits remained inconsistent, the market punished the stock, pushing it into low-price territory despite its massive user base. Clean energy is another area where many stocks trade under $10 while still attracting attention. Plug Power, a company focused on hydrogen fuel cell technology, operates in a sector that could benefit from long-term energy transitions. The problem is timing. Hydrogen infrastructure is expensive, government policy shifts slowly, and profitability remains uncertain. Plug Power's stock price reflects this uncertainty, not necessarily the absence of opportunity. Investors who follow this stock understand they are betting on future adoption rather than current earnings, which is why the stock remains volatile and low-priced. Entertainment and consumer-facing businesses have also struggled in recent years, pushing some famous names under $10. MC Entertainment, the largest movie theater chain in the US, faced massive challenges during and after the pandemic. High debt levels, changing consumer habits, and competition from streaming services placed heavy pressure on the business. While AMC gained attention from retail investors, the underlying financial challenges never disappeared. The stock price reflects ongoing questions about long-term profitability. Even though movie theaters continue to operate and generate revenue, what connects all these companies is not weakness alone, but uncertainty. Markets hate uncertainty more than bad news. When growth is unclear, profits are delayed, or industries are changing rapidly, investors demand a discount. That discount often shows up as a low stock price. This is why under $10 stocks are not automatically bad investments, but they require much deeper analysis than expensive, stable blue-chip stocks. Another important reason many of these stocks stay low is dilution. Companies that are growing or surviving difficult periods often issue new shares to raise capital. While this helps the business continue operating, it reduces the value of existing shares, keeping the price under pressure. Investors who do not understand dilution often panic when they see the price drop, even if the company is strengthening its balance sheet. Debt also plays a major role. When interest rates rise, companies with high debt become riskier. Stocks like AMC or capital-intensive companies like Lucid are affected more than cash-rich firms. Investors price this risk into the stock, pushing it lower. Understanding debt maturity, interest costs, and cash flow is essential before touching any low-price stock. Psychology is another powerful force. Stocks under $10 are often ignored by large institutions, leaving retail investors to dominate trading. This increases volatility and emotional price swings. One piece of news can cause a stock to jump or crash dramatically. This is why discipline matters more here than anywhere else in the market. Smart investors do not chase these stocks blindly. They watch earnings reports, study management decisions, and track industry trends. They accept that some investments will fail, while others may take years to work. Under $10 stocks are not about quick riches, but about understanding risk and reward properly. When you step back and look at the US stock market as a whole, these companies represent something important. They show how quickly markets can change their opinion and how price does not always equal value. Some of today's under $10 stocks were once market leaders, and some may recover while others fade away. The key difference is research, patience, and emotional control. For beginners, these stocks offer an education in how markets really work. They teach you how sentiment, fear, and expectations shape prices more than headlines suggest. They also remind you that no investment is guaranteed, no matter how cheap it looks. At the end of the day, $10 US stocks are not lottery tickets, and they are not trash by default. They are businesses going through challenges, transitions, or early growth phases. If you learn to analyze them correctly, it can help you build knowledge, confidence, and discipline as an investor. And that understanding is far more valuable than any short-term price movement. As we come to the end of this video, the most important thing to remember is that a stock trading around $10 is not cheap or expensive by default. It is simply misunderstood. Every company we discussed today represents a real business with real employees, real products, and real challenges, and the market is constantly deciding how much confidence it has in their future. Some of these companies may recover and surprise investors, while others may struggle for years or even fade away. The difference is never the price tag, but the strength of the business and the decisions made by management over time. This is why smart investors focus on understanding the story behind the stock, not just the number on the screen. If you are a beginner, let this video be a reminder that the US stock market is accessible, even with limited capital, but it demands patience and discipline. Never invest money you cannot afford to lose, and never rely on hype, social media trends, or emotional decisions. Take time to study earnings, debt, industry trends, and long-term vision before putting your hard-earned money at risk. Low-price stocks can teach powerful lessons about risk, psychology, and market behavior if you approach them with the right mindset. Knowledge will always protect you more than blind optimism. If this breakdown helped you see $10 stocks in a new way, make sure to like this video, so it reaches more people who want to learn smart investing. Subscribe to the channel for more deep dives into affordable US stocks, market psychology, and beginner-friendly analysis. Let me know in the comments if you want a part 2 where we focus on one specific company in full detail. Until then, remember one simple rule. Successful investing is not about finding the cheapest stock. It is about understanding the right one.